Hey everyone, it's Justin again with Confident Options. Today we're going through trades closed on 8/3/2018, Friday, August 3rd. Hope everyone had a great week. We had a couple closing trades today, 3 of them earnings, and 1 was a core strangle position for the portfolio. So I want to go through these real quickly so we get you guys out of here to the weekend. First up was a strangle in FXI. FXI has been good to us. We traded as part of kind of the core portfolio that we have, and so we ended up taking the strangle here. So we go over to the charts. The white arrow represents the strangle entry. So we entered here back on 7/16, where we sold the 45 call. Let's tighten this up a bit. 45.50 call. So that's in between here. And we also sold the 39.50 put, which is lower than is on the screen here, so under the 40s here. So again, put side, call side. We took in a credit of 60 cents on the trade. So from here, we gave it nice tons of room to move around, which we know it typically does. It gaps, it moves around, which is totally fine. We let the probabilities work out on our end. We typically sell about the 15, 16, 17 delta strikes on these core portfolio strangles, and we usually try to stay around the 45 days out till expiration. So these were a perfect example of what we typically do. So we were pretty opportunistic. It shot up, came back in, and we went ahead and closed it out. We closed it out a little ahead of our profit target. Typically we look to profit about 50%. We closed out a little bit ahead because today we're trying to clean up the deltas in the portfolio. We always want to try to stay delta neutral, very neutral outlook on the markets. We believe, and the research shows, that the market typically moves within a range up and down. So we hate one-sided action, whether it's one-sided down or one-sided up. We want to see moves up and moves down and all around. So that's what plays into our strengths. So again, we sold the 45.50 calls, 39.50 puts for 60 cent credit, and we closed it out for 36 cents today by buying back both the calls and the puts. So on a real small account where you only traded one contract, you would have made 12 bucks, and the capital required was really small too, so only under $300 for that trade. So you can scale up based on the size of your account. Now jumping into earnings, pop over to our analysis for earnings going into the close on 8/2. So that means stocks reporting after the market close on 8/2 and before the market opens on 8/3. And this is what we presented yesterday, and I'll quickly recap it for anybody that missed. The blue bars represent the expected move in percent. So GoPro expected move was just under 15%. The red bars here represent the one standard deviation move of all past earnings events, and this is the 2. So this is the 1, and this is the 2. 2SD. Okay, 1 standard deviation, 2 standard deviation. You can see how that kind of moves for each stock. The green line here represents the number of occurrences, and that's based on the right axis here. So this had about 36, 37 occurrences, meaning it's reported earnings 37 times in its life. And typically we only go back to 2009. So some of these stocks are a lot older. A lot of them are younger too. So GoPro's only had about 15 quarterly earnings announcements. So just visually looking at the chart here, we focused on SHAK. See, it's above the 1 standard deviation move. We focused on Noble Energy, which was actually the best one because it was above both the 1 and the 2, which is always positive. Dish was right at the 1, which is in our favor, and CBOE was at the 1. So remember, this 1 standard deviation move represents 68% of past occurrences, and the upper is 95%. So 95% confidence that if they're pricing out above 95%, that means we go pretty strong on those, pretty heavily into those, because the odds are on our side. Okay, so the first one up was SHAK, which is right here. So if we go over to the chart for SHAK, Shake Shack. I know you guys like Shake Shack. I enjoy Shake Shack too. Not gonna lie, we just got one here in Denver, I don't know, a couple months ago, and I frequent it. So here's the close. Closed at about 63.91. We'll call it 64. So we ended up selling the 70.50. So way up here, right above this line. And then we also sold this 56.50. So somewhere down in here, 55, 56. It's actually breached that now. That's why we close them right in the morning. So opened or closed here. So we were very neutral. We said, all right, we're going to give you all the room you need to go up and down. If we look at the data in the expected ranges to give us an idea of what we're looking at, draw this back. So SHAK, they're expecting a move of $6.50. And so we were well outside that on both sides. The stock ended up opening up pretty much unchanged. It was down like $1. The expected move was 6. That means the favorable on our side, and then the obvious earnings crush here, which is what we want to see. It went from about 100 to under 30. Excuse me, under 40. So all the way down here. That's a huge earnings crush move. This was actually our most profitable earning trade of the entire year. We were able to sink our teeth into this quite a bit, as you'll see on the trade recap here. So we ended up taking the 70.50, 56.50 strangle. We collected a huge credit, $1.85, and we only closed out the put side, which you see why we closed out the put side. 56.50, it's already breached. 56.50 just barely breached it there, but up here in the morning, you know, it's not worth anything. The expectation is that the earning or the crush has occurred, the extrinsic value has been sucked out of it, and so we close it out when we have the profit, and this is a perfect example why we do that. So we closed it out for 28 cents, so we captured a huge amount of the credit of the premium. I mean, so about 85%, and this was actually a really cheap trade to get into. So we scaled up pretty big. It only cost about $650 to get into one contract, and so we were in the 5-6 contract range, I believe. 5 contracts actually. So big win for us. Super excited about this trade. The power of earnings and evaluating the move against past moves has been really killer for us this year. Trade number 2 for earnings was Dish. Pop over to the chart here. So Dish, we sold the 32.50, 27.50. While that's loading up, we can look at the numbers here. So Dish expected move was under $2, $1.83. And if we look at the chart here, they've just been getting crushed. I think it's down like 50% or something this year. So we knew if it was going to be a positive announcement, you could have some pretty good short squeeze occurring, which is what's happening today. And again, here's another example why we close out that tested side or both sides if we're able to right away, because the stock really, really moves after these events sometime. So quickly, let's go through this. So we closed here about 30. We sold the 32.50. So we were up here. I think this is 32.50. This must be 34. So we were somewhere down there. And the 27.50. So 27.50, somewhere in between here, right? Just very generic, just drawing lines here so you give you perspective of what we're looking at. So call, put side is always below on these strangles. So we gave it nice wide room. It was expecting a move of under $2, and we gave it 250 on each side. And we know that the standard deviation move was less than that. The one standard deviation move was less than that. So it did exactly what we wanted. It opened right inside of our range. It opened to the upside, so we closed out of the challenge side, the call side here. And we left the puts, and we let them go ahead and expire worthless at the end of the day. It's not worth closing them out. I'd rather just let them go. At our brokerage, we don't pay commissions for closing, so it wouldn't really matter. But I would have had to close it for 5-10 cents, and I'm just going to collect that because there's obviously no risk here. If it started moving up and then it just crumbled for whatever reason, we would go ahead and close it out, and that it is what it is. It's happened before, so sometimes we do that, but when we open up in one direction, we usually continue in that direction, so we wanted to close out the call side on this guy. So again, if we would have left the call side alone, it would have been in the money now. We would have had to deal with rolling or getting a sign, etc. So going back to the recap here, again, we sold the 32.50, 27.50, call, put, strangle, and we only closed out of the put side. The call side, this is incorrect. I'll fix that. This should be call right here, not put. So 32.50 call for 18 cents. So we captured over 55% of the premium, and it was almost 7% return on capital. Another cheap trade. These were awesome because they're lower price stocks. It only cost $372 to get into one contract. So again, we boosted up our size on this pretty dramatically to fit our account size, and we had a nice winner. So we're doing really good this month and this year. So July was a killer month for earnings, and August is starting out to be a killer month on earnings. Last one, CBOE. We'll wrap this up. So CBOE, as that loads, looks like everybody's trying to close out trades right now or something because the markets are, my charting is slow. So CBOE was pricing a move of about 2.7%, which is about the same move in the stock since it's about a $100 stock, to $2.60 move. This was just right above the standard deviated move, so it was less of a priority for us, but we still went ahead and took it, and we're glad we did. So we sold the 99.92 strangle, and we always sell the frontmost weekly contracts, the ones that are expiring this week. So let's draw up what we got here. So here's our close on the day before earnings, and so what we did was the 99, so that was up here, and the 92 or 93, excuse me, and that was down here. So it's a small range, but you have to remember this is all relative to the past moves of the stock. Whereas some of these I'm drawing them way out because the pricing is pricing in a lot higher move or a lot larger move, and so it's all dependent on the the stock and what it's done in the past and whatnot. So keep that in mind. So our calls are up here, our puts are down here. It opened up right inside of our range. It kind of opened up pseudo in the middle, and so we went ahead and closed off both sides just to remove any risk because we didn't get a ton of crush here, but it still ended up being a profitable trade, which is just amazing to me that it's this simple, but it really is. I mean, there's nothing. I sound like a broken record on every night on these, but they really do work, and you just got to be really strict on when you're entering them and what you're entering. So 99.93, 77-cent credit, closed out for 35 cents, almost 55% credit capture. This is a much higher price stock, so you're talking about $99 here, about $100. So you're going to pay more margin to get in. So $1,600 and $42 for a single contract trade. We didn't go quite as large on this one just because we have to keep it within. We have to keep this number within our risk parameters, and so that's what we traded. We didn't trade one. I think we traded a handful, 3, 4 contracts on this one. So good trade. So all in all, 3 for 3 earnings trades were successful, and then the one closing strangle trade. As always, if you guys have any questions, shoot me an email or visit the box at the bottom of this page. Scroll down there, and you can enter in your name, email, and a question, and we'll get back to you as soon as we possibly can. Hope you guys have a great weekend. We'll talk to you next week. Bye.